Right. Let's talk about investing. You know you should be doing it, but every time you look into it, you're met with a wall of gobbledygook about expense ratios and PE, and it all just makes your head spin. You're worried you'll make a daft mistake, click the wrong thing, and watch your hard-earned money vanish. It feels far safer to just stick it in a savings account and do nothing. But what if I told you that in the next few minutes, that feeling of confusion is going to completely disappear? What if I told you investing isn't some exclusive club for pinstripe suits in the city? It's for everyone. And today, I'm going to translate it all into plain English for you. I'll walk you through the absolute first steps to making your very first investment with no jargon and no complicated charts.
By the end of this video, you won't just have a clear step-by-step plan, but you'll also know exactly how to open an account and confidently buy your first investment. This is your official permission to stop putting it off and start building your future. Section 1. The why that actually matters. Before we get into the how, let's quickly cover the why. Why can't you just keep your money safe in a savings account? The simple answer is one word: inflation. Think of inflation like a slow puncture in your tire. Every year, the prices of things, petrol, groceries, housing, tend to creep up. If your money's just sitting there, earning next to nothing in interest, it's actually losing its spending power. That £100 note in your savings account today might only buy you £97 worth of stuff next year. Investing is the opposite of that. It's about making your money work for you so it can grow faster than inflation. It's about turning your money into more money over time. This isn't about gambling or get-rich-quick schemes. It's about protecting your financial future and building wealth steadily. The goal isn't to beat the market, it's to be in the market. And the best time to start was yesterday. The second best time is right now.
Section 2. Step 1. Choose your investment account. Okay, let's get practical. To start investing, you need a specific place to do it. This is called an investment account or a brokerage account. Think of it like a special account designed to hold your investments instead of just cash. For 99% of beginners in the UK, there are two main types of accounts to know about. First, there's the Standard General Investment Account, GIA. This is the most flexible option. You can put money in, invest it, and take it out whenever you want without any special rules. It's brilliant for general wealth building or saving for a goal that isn't retirement, like a house deposit in 5 or 10 years' time.
Second, there's a stocks and shares ISA. An ISA is an individual savings account, and it comes with massive tax advantages. It is the closest UK equivalent to the American Roth IRA. With a stocks and shares ISA, you put in money that you've already paid tax on, but then it can grow completely tax-free. When you take it out, you don't owe the tax man a single penny on your profits. It's one of the most powerful wealth-building tools you can use. So, which one to choose? If you don't have a workplace pension or want to maximize your tax-efficient savings, a stocks and shares ISA is a fantastic place to start. If you've already used up your annual ISA allowance or want to invest for goals outside of that wrapper, a general investment account is your best bet. Honestly, you can't go wrong with either, and many people have both. The most important thing is to just pick one and get started.
Section 3. Step 2. Open the account. It takes 15 minutes. This part sounds like a hassle, but I promise it's as easy as signing up for Netflix. You're going to choose an online broker. In 2025, you have loads of fantastic user-friendly options. The big established names like Hargreaves Lansdown, AJ Bell, and Vanguard are amazing choices. They're well-known, offer great service, and have a huge selection of investments. Then you have the newer mobile-focused apps like Freetrade and Trading 212, which are famous for their incredibly simple interfaces and low costs. Don't get stuck here. This is what's known as analysis paralysis.
All of these are great options. They all offer commission-free trading on most shares and ETFs, and many have no account minimums, meaning you can start with whatever amount you have. Pick one that looks good to you and go for it. Here's what you'll generally need to open the account: your national insurance number, your driving license or passport, your bank account details, sort code and account number to link for transfers. The online application for any of these brokers usually takes about 10 to 15 minutes. You'll fill out your personal details, answer a few questions about your finances, and agree to their terms. And that's it. You've just opened the door to your financial future.
CTA. If you're finding this simple breakdown helpful and you're feeling a bit less intimidated, do me a favor and give that like button a quick tap. It tells YouTube this video is genuinely useful and helps other beginners find it. And if you want to keep learning how to manage your money with confidence, make sure you subscribe. Section 4. Step 3. Fund your account. Start with £20. Once your account is approved, which usually happens within a day or two, it's time to put some money in it. This is a massive mental hurdle for so many people. They think they need thousands of pounds to even begin. That is completely untrue. Thanks to something called fractional shares, you can now buy a small slice of a company's stock for as little as £1 or £2 on many platforms. This means you don't need £500 to buy a share in a company that costs £500. You can buy £20 worth or even £5 worth. So how much should you start with? Start with an amount that doesn't feel scary. If that's £100, brilliant. If it's 20 quid, that's also brilliant. The goal of your first investment isn't to make a fortune overnight. It's to prove to yourself that you can do it. It's to break that psychological barrier and become an investor. Link your bank account and transfer that first small amount. Section 5. Step 4. Choose your first investment. The easiest way. All right, the moment of truth. The money is in your account. What on earth do you actually buy? You're looking at a screen with thousands of company names, ticker symbols, and numbers. It's overwhelming. I'm going to give you the simplest, most effective, and most recommended starting point for almost all new investors: a low-cost S&P 500 index fund. Let's break that down into plain English. An index fund is like a massive shopping basket that holds tiny pieces of lots of different companies. Instead of trying to pick one single winning stock, which is incredibly difficult, you just buy the whole basket. An S&P 500 index fund specifically holds small pieces of the 500 largest and most successful companies in the United States. Think Apple, Amazon, Microsoft, and Google. Why is this the perfect first investment? 1. Instant diversification. By buying just one thing, you are instantly invested in 500 companies across dozens of industries. If one company does poorly, it has a tiny impact on your overall investment. It's the definition of not putting all your eggs in one basket. 2. It's low cost. Index funds are passively managed, a fancy way of saying a computer just makes sure the fund follows the market. This makes them incredibly cheap to own. You'll pay a tiny fee called an expense ratio, often as low as 0.03% to 0.07%. That's as little as 30p a year for every £1,000 you have invested. Proven performance. Historically, the S&P 500 has delivered strong long-term returns. While past performance is no guarantee of future results, it's a bet on the long-term success and innovation of the American economy. To buy it, you'll simply log into your new investment account, use the search bar to type in the ticker symbol for an S&P 500 ETF that trades on the London Stock Exchange, like UVSA or IUSA, enter the pound amount you want to invest, and click Buy. That's it. You've done it. You are officially an investor. Section 6. Step 5. Automate everything. The set it and forget it strategy. The real secret to building wealth through investing isn't about brilliant stock picks or trying to time the market. It's about consistency. And the best way to be consistent is to put it on autopilot. This strategy is called dollar cost averaging. It sounds technical, but it's dead simple.
It just means investing a fixed amount of money at regular intervals, say £100 every single month, no matter what the market is doing. When the market is up, your £100 buys fewer shares. When the market is down, that same £100 buys more shares. Over time, this smooths out your average purchase price, and more importantly, it takes the emotion out of it all. You're not trying to guess the perfect time to buy, you're just buying consistently, and that's the habit that builds serious wealth over the long term. Go into your brokerage account right now and set up an automatic transfer and investment. Decide on an amount you can comfortably invest every week, every 2 weeks, or every month. Automate it. This one single action is more powerful than any complex trading strategy you'll ever read about.